December 11th, 2025. Silver has just smashed through $62 an ounce. We are witnessing a vertical move that defies every technical model on Wall Street. But if you are staring at the ticker tape thinking this is a profit opportunity, you are missing the catastrophe hiding in plain sight. We are not watching a rally, we are watching a run on the bank, where the bank is the global silver supply and the vaults are already empty. Before we unravel the geopolitical and mathematical inevitability of what is happening, do me a quick favor and hit the like button or drop a comment below if you want to stay ahead of the financial curve. It helps us get this critical data out to more people who need to see it. The story begins not on the trading floor of the New York Mercantile Exchange, but deep within the bureaucratic machinery of the Russian Federation. In 2024, a pivotal shift occurred that went largely unnoticed by the mainstream Western financial press. Yet it signaled a fundamental change in how sovereign nations view hard assets. For the first time in over 170 years, a major global superpower officially designated silver as a strategic reserve asset. This was not a rumor or a leak. The Russian Finance Ministry explicitly allocated 51 billion rubles, which translates to approximately $535 million, specifically for the purchase of precious metals, including silver, platinum, and palladium, over the fiscal period of 2025 through 2027. This decision marks a complete reversal of the monetary policy that has dominated central banking since the mid-19th century, where silver was relegated to the status of a mere industrial commodity or a secondary investment vehicle, stripping it of its historical role as a primary monetary reserve. The logic behind Moscow's decision is rooted in the harsh realities of modern economic warfare and the lessons learned following the freezing of approximately $300 billion in Russian foreign exchange reserves in 2022. That event sent a shockwave through the non-Western world, demonstrating that sovereign reserves held in fiat currencies like the dollar or the euro are essentially IOUs that can be cancelled or frozen at the whim of the issuing nation. By pivoting to physical precious metals stored within domestic vaults, Russia is effectively sanction-proofing a significant portion of its wealth. Unlike digital ledger entries in a Western bank, a physical bar of silver cannot be frozen. It cannot be hacked, and it cannot be confiscated by a foreign treasury department. However, this purchase program is not merely a defensive posture against sanctions. It is a calculated offensive strategy based on industrial foresight. Russia, already a major producer of platinum and palladium, understands that the global economy is electrifying at a pace that the mining sector cannot match, and they are positioning themselves to hold the keys to the supply chain. While Russia's strategy is public and documented, the situation in China presents a far more opaque and potentially explosive dynamic. China currently holds approximately 70,000 metric tons of silver reserves in the ground, ranking third globally behind Peru and Russia, and they produced roughly 3,300 metric tons of silver in 2024. On the surface, this sounds like a surplus, but when you overlay their consumption data against their production figures, a terrifying math problem emerges. China's industrial appetite for silver, driven by their absolute dominance in green energy manufacturing, is consuming metal at a rate that far outstrips their domestic output. Market analysts indicate that China now manufactures over 80% of the world's solar panels, and every single one of those photovoltaic cells requires silver paste to conduct electricity efficiently. There is simply no commercially viable substitute for silver in these applications, because it is the most conductive metal known to physics. Furthermore, Chinese electric vehicle production surged by 40% year over year, and an electric vehicle requires nearly twice the amount of silver used in a traditional internal combustion engine for its battery management systems and extensive electronic connections. When you add the rapid build-out of 5G infrastructure, which requires silver-plated components for signal integrity, and the booming construction of AI data centers, the conclusion is inescapable. China is running a massive silver deficit. The math simply does not work unless they are aggressively importing massive quantities of physical metal from the international market. Unlike Russia, Beijing does not always announce its silver purchases with press releases, but the import data and the relentless drain on global exchanges tell the story for them. They are not just buying to build cars and panels today. The data patterns suggest they are engaging in strategic stockpiling, similar to their multi-year accumulation of gold. From 2010 into 2022, China used periods of suppressed prices to accumulate gold, and by the end of 2024, their official gold reserves had reached over 2,200 tons. It is highly probable, given the strategic importance of silver to their industrial dominance, that they are applying this same methodology to silver, buying quietly while prices are low and supply is available. This geopolitical accumulation is occurring against the backdrop of a silver market that is already broken fundamentally. The Silver Institute's 2025 World Silver Survey reported that the global market is heading into its fifth consecutive year of a structural supply deficit. To understand the severity of a structural deficit, we have to look at the raw numbers. In 2024 alone, total global demand for silver reached approximately 1.16 billion ounces, while total supply from all mining and recycling sources only reached 1.1 billion ounces. That leaves a gap of roughly 148.9 million ounces in a single year. When you aggregate the deficits from 2021 through 2024, the cumulative shortfall is a staggering 678 million ounces. To put that in perspective, the world has consumed the equivalent of 10 months of total global mine supply without replacing it. This deficit is being filled by draining above-ground stockpiles, but those stockpiles are finite and are depleting at an alarming rate. The inventory data from the COMEX and the London Bullion Market Association offers the most damning evidence of this trend. In February 2021, the COMEX held approximately 152 million ounces of registered silver, metal that is warrant issued and available for immediate delivery against futures contracts. By late 2024, that number had plummeted to approximately 73 million ounces. That represents a decline of over 50% in less than 4 years. The situation in London is equally precarious, with inventories falling to near all-time lows of around 827 million ounces in December 2024. However, the headline number for London is misleading because approximately 551 million ounces of that total are held by exchange-traded funds, meaning it is not available for general market circulation. This leaves a float of roughly 276 million ounces to service the entire global wholesale market. The industrial demand that is driving this drain is not cyclical. It is structural and permanent. Industrial use hit a record 680.5 million ounces in 2024, marking the fourth consecutive year of record highs. This silver is not being bought by investors to sit in a vault. It is being consumed in industrial processes, locked away in solar panels on rooftops, buried in landfills inside discarded electronics, or installed in 5G towers. Unlike gold, which is hoarded and recycled at a high rate, a significant portion of industrial silver is consumed and effectively lost to the market forever because recycling it is often not economically viable. For example, while we can recycle silver from jewelry or silverware, recovering the tiny amounts of silver used in electronics is difficult and costly, yielding only about 18% recovery rates. Solar panels, which now account for nearly 30% of industrial demand, lock that silver away for a lifespan of 25 to 30 years. Governments worldwide are mandating renewable energy transitions, which means the demand for solar panels is driven by policy, not just consumer choice. This creates an inelastic demand curve where manufacturers must buy silver, regardless of the price, to meet government quotas and production targets. On the supply side, the mining industry is facing a crisis of elasticity. Logic would suggest that if prices rise, mines should simply produce more, but silver geology does not cooperate with that economic theory. Approximately 70% of the world's silver is produced as a byproduct of mining other metals like copper, lead, and zinc. This means that a silver miner is usually actually a copper miner who happens to find silver. Consequently, the supply of silver is dictated by the demand for base metals, not the price of silver itself. If the global economy slows down and demand for copper or zinc falls, silver production will decrease even if silver prices are skyrocketing. Primary silver mines, which account for only about 28% of supply, are in a long-term state of decline because the easy, high-grade deposits were mined decades ago. What remains requires deeper shafts, more energy, and more capital to extract lower grades of ore. Developing a new mine from discovery to production takes 5 to 10 years of permitting and construction, meaning that even if the price doubled tomorrow, no new significant supply would hit the market for a decade. This inelasticity of supply combined with inelastic industrial demand creates the perfect setup for a price explosion. We are seeing a classic squeeze scenario developing, similar to what happened in the nickel market in 2021 or the palladium market in 2020, but on a much larger and more critical scale. The paper market for silver is massively leveraged, with open interest on the COMEX often representing hundreds of times the amount of physical metal actually available for delivery. As of late 2024, the open interest represented approximately 226% of all vaulted silver and a staggering 1,800% of registered silver. This system functions only as long as investors are willing to settle their contracts in cash or roll them over to the next month. But what happens when major players like Russia or China decide they want the physical metal instead of a cash settlement? What happens when an industrial user like a solar manufacturer realizes that supply is tight and demands physical delivery to keep their factory running? The leverage becomes a liability. If even a small fraction of the paper claims stood for delivery, the COMEX would default, and the disconnect between the paper price and the physical price would become undeniable. We saw a preview of this in 2020 when the spot price of silver was around $28, but physical coins and bars were selling for $45, a premium of nearly 60%. Dealers were sold out, mints were backlogged, and the paper price became irrelevant to anyone who actually wanted to hold metal. That was a temporary panic, driven by retail investors. The coming squeeze is structural, driven by sovereign nations and industrial giants. Russia's decision to allocate reserves to silver is a signal that they expect this disconnect to become permanent. They are securing their position before the shortage becomes front-page news. The geopolitical dimension cannot be overstated. As the world fragments into competing economic blocs, with the BRICS nations actively seeking alternatives to the US dollar, hard assets are regaining their status as the ultimate form of settlement. If trust in fiat currencies continues to erode due to soaring global debt levels and inflation, central banks will continue to diversify into gold and silver. We have already seen central banks buy over 1,000 tons of gold annually for 3 consecutive years, driving gold prices from $2,000 to over $4,000. Silver is the logical next step in this diversification. It is historically undervalued relative to gold, with the gold-to-silver ratio sitting at approximately 72:1, compared to the historical mining ratio of roughly 8:1 and the historical monetary ratio of 15:1. If silver were to revert even partially to its historical mean, relative to gold, prices would mathematically have to rise to between $150 and $200 per ounce. This is not speculation. It is simply a reversion to the mean. Furthermore, the Federal Reserve's anticipated rate cuts in late 2025 are likely to weaken the dollar further, adding another tailwind to precious metals. A weaker dollar makes commodities more expensive in nominal terms and drives investors toward safe haven assets. When you combine a weakening currency, a structural supply deficit, dwindling inventories, and strategic accumulation by geopolitical rivals, the case for silver becomes overwhelming. The price of $58 or $61 is merely the market beginning to price in the risk of a total stockout. The ultimate trigger for the massive revaluation will likely be the moment when the physical shortage moves from the wholesale market to the industrial supply chain. When a major tech company or solar manufacturer misses a production target because they cannot source silver paste, panic buying will set in. Industrial users do not care about the price. They need the metal to operate. They will bid the price up to whatever level is necessary to secure supply, and because supply is inelastic, the price response will be vertical. We are standing at a precipice where the suppressed valuation of silver is colliding with the reality of physical scarcity. The actions of Russia and China suggest that they have done the math and are acting on it. They are draining the vaults while the Western world is still debating inflation metrics. By the time the average investor realizes that the vaults are empty, the opportunity to acquire physical silver at these levels will have vanished. The transfer of wealth is already underway, moving from those who hold paper promises to those who hold physical resources. This is a structural shift in the global financial order, masquerading as a commodities cycle. The data regarding deficits, inventory drains, and strategic accumulation is public for anyone willing to look, but it requires ignoring the noise of the daily news cycle and focusing on the fundamental flows of metal. The window for action is narrowing as the available float on the London and New York exchanges continues to evaporate. Thank you for taking the time to understand the gravity of this situation. If you found this deep dive helpful, please share it with others who need to wake up to this reality. Leave a comment with your thoughts on where you think the price is heading, and don't forget to subscribe for more unfiltered financial intelligence.